In this lesson, we're going to look at the next step of our multi-step scenario here where Apple orders iPhone inventory and then manufactures it into iPhones and then actually sells it to customers. So just to recap, in the first video here, we assumed that inventory went up by 100. So I have 300 here instead of the 200 from before. And we also assumed cash went down. So I have 450 here instead of the 550 from before. So with this in place, we know that inventory is up and that cash is down from some of our previous changes. Now what we want to do is go in and figure out how actually selling these iPhones, manufacturing and selling them, is going to affect the three statements. As with everything else, you want to get from the interviewer the proper assumptions here, namely figure out what revenue they're going to be selling them for, and then figure out how much it's actually going to cost to sell them. And you're going to have to use those when you frame your answer to this question. So in this case, recall that the inventory originally changed by 100 right here. So we're just going to assume that the cost of goods sold is also 100 for simplicity. We're going to assume that they sell them for 200 worth of revenue here. So let's just go in and enter these changes, 200 for revenue and then 100 for cost of goods sold. We're not going to enter anything on inventory changes by here because remember that inventory and cost of goods sold are already linked properly in our model. So there's no need to do that in this case. So let's start with the income statement and go through what happens here. So revenue is up by 200 from our assumptions. Cost of goods sold is up by 100. So overall, gross profit is up by 100 here. Operating income is then up by 100. Pre-tax income is up by 100. And so if you assume a 40% tax rate, then our net income here is up by 60. On the cash flow statement, net income is up by 60. Inventory here has gone down by 100 because we've sold this inventory. We've manufactured it into finished products and sold it now. So this has gone down by 100. An asset going down is an addition to our cash flow. So this actually increases our cash flow by 100 here. And so cash flow from operations is up by 160 overall. No changes to investing or financing activities. So overall, our cash here is up by 160. On the asset side of the balance sheet, so cash is up by 160. Inventory is down by 100 because we've sold it now. Remember that inventory here is linked to cost of goods sold because we're adding in any new inventory purchases here and then subtracting the cost of goods sold. So that's how they're linked. So our total assets here are up by 60 because cash has gone up by 160, inventory has gone down by 100. 160 minus 100 is 60. On the other side, no changes to liabilities. But under shareholders' equity, our retained earnings here is up by 60 because our net income on our income statement was up by 60. So overall, liabilities and shareholders' equity here are up by 60. This side is up by 60, and then the asset side is also up by 60, and so our balance sheet here balances. So that's how you go through a simple scenario here where a company orders inventory and then manufactures it into finished products and sells it to customers. The important points to keep in mind here are that with inventory, nothing is recorded as an expense until it's actually sold. Then when it's actually sold, you record the revenue and cost of goods sold, the changes on your income statement. That flows through. Then on your cash flow statement, you have the change in net income. Remember that inventory going down here will actually increase your cash flow. This is a common mistake to miss this one or to reverse it, so keep that in mind. Once you have your change in cash here, cash is going to go up from selling these products, of course. You reflect it on the balance sheet and the fact that inventory goes down. And then as with everything else, the change in net income will always flow into shareholders' equity here. And so that's how the balance sheet balances. So not too complicated, certainly easier than the other multi-step scenario we saw, but it's just important to keep everything straight. I think the trickiest thing with this question is figuring out how inventory plays into it, and specifically remembering that inventory going down here will actually cause your cash flow to go up on the cash flow statement, and also that inventory is not recorded as an expense until the goods associated with it are actually sold. So that's how you go through a simple multi-step scenario like this where a company actually orders inventory and then manufactures it into finished products and then sells them to customers.